The US system is kind of paralyzed and not innovating, and the rest of the world wants dollars. And so getting to 24/7 settlement systems real time has actual pretty deep value. 24/7 real time in general, probably a more efficient system overall. And even for people who are like, yeah, but should we run everything like that? The answer is we don't have to, but you can't make a slow system go faster. You can make a fast system go slower. This would be the equivalent of me having a debit card that is backed by a government money market fund and my being able to pay people literally in the shares of the government money market fund. So now instead of having credit exposure to banks, instead of having to think about their risk, instead of having to think about their lending, I can just be like, look, unless the US government goes bankrupt, I'm good. And so this greatly simplifies the system and allows users to take the amount of risk they want to take to use a system for payments, not just in the US, but everywhere.
This episode is sponsored by Mantra. The Mantra chain is the purpose-built Layer 1 blockchain designed for tokenized real-world assets and regulated digital assets, offering scalable, high-performance architecture. Positioned as the blockchain for tokenized RWAs, Mantra is onboarding traditional financial institutions into Web3. Join the ongoing OM Gendrop campaign and be part of the future of regulated digital assets today. Welcome back to another episode of On the Margin, and joining me today is Austin Campbell. Austin, it's great to have you. I'm really excited for this conversation because one of the big issues I have these days is it feels like a lot of people in the TradFi world and the crypto world keep talking past each other, and a lot of crypto people keep reinventing the wheel, and you're the perfect guest to unpack that. So it's great to have you.
No, thank you very much. I'm happy to be here.
First off, I just want to hear a little bit about your background because I think it's really relevant to this conversation that we're about to have here.
I started my career in financial services proper after business school when I joined JP Morgan. And at JP Morgan, I got stuck into a slightly misleadingly named business called insurance-linked securities. And why I say slightly misleadingly is many of the financial guarantee products, so the things that keep $1 stable NAVs for things like stable value funds, bank-owned life insurance, and we were involved in money market reform on that desk, lived in that group. So there, when you say insurance, people think of like autos, homes, things like that. But here it also covered financial products. And, I would say the core answer I was grappling with at JP Morgan for about a decade was, how do we make financial products that are actually stable so that in times of stress like 2008, they will retain a $1 value instead of breaking? So you can see with that background that naturally leads to crypto as stablecoins begin encroaching upon that space and attempting to do that. So after JP Morgan, I ended up at Stone Ridge, which is NYDIG's parent, if anybody's ever heard of them. So got into Bitcoin, was looking at sort of lending and safe structures for doing that so you don't blow up. And then I was at Citi as the co-head of digital assets and global rates. And then I was at Paxos running the stablecoins, like back-end reserve management, all of those things. And so ended up doing it with my hands for quite a while. Now at this point I teach and, I'm trying to, shall we say, good information across the bridge to both sides, exactly as you said.
Yeah, and that's a really valiant effort because we need a lot more of that these days. So, okay, cool. So let's tap your experience at times at places like JP Morgan and just really unpack the modern dollar system, the modern payment system, the modern money market fund system, and some of these key components of this, modern financial complex. And then what are some of the potential, issues that you saw in your experience that led you to go all in on this idea of crypto and stablecoin design like you did at Paxos?
I'm going to start by using one of the tactics that I use in my class to explain this problem to people, which is asking the question of, why do you have a bank account? Right? Just asking people in general, why do you have a bank account? And the number one answer and the number two answer that I get when I ask people, like we rank them on the board, it's to pay for things and a place to put my money, right? Those are, by and large, if you ask the average two-legged person or even corporate treasurer, why do you have accounts? Those are the answers. Here's the interesting part. When I ask, well, wait, hold on, how many of you wanted to lend money to a real estate billionaire? None of the hands go up, right? And so one of the things that you run into right out of the gate with the modern banking system that we have in the United States is we have essentially disfavored narrow banks, trust banks, like things that I'm going to say for the mental simplification in your head, I give you $1, you put it in T-bills, we walk away, everybody sleeps at night. in favor of the model of I give you $1 and you go make like risky commercial loans with it one way or another. Maybe it's mortgages, maybe it's like commercial real estate, maybe it's trade finance. Like there's all sort credit cards, there's all sorts of things banks do, right? But the point is none of it is I just bought T-bills and went to bed. And as a result of that, when you're putting money in a bank account, you are exposed to credit risk in very opaque ways where, the average user, if we're being totally honest, can't understand whether their bank is safe or not. It's a little bit crazy to ask them to. And then number two, because our whole payment system has electronified on the back of banks, it's actually quite hard to find good options to pay for things where a bank is completely not involved. And you're not just taking credit risk to another entity. Like I can have a PayPal balance, but I'm in the exact same position if PayPal goes bankrupt, maybe even worse without FDIC insurance than I would be if I had left my money at a bank. And what this has done in the US system is one, really inhibited some of the innovation, and two, sort of caused a lot of the problems with the too big to fail banks getting bigger and bigger and bigger, because when there's this desire for safety and simplicity and our regulatory structure has essentially banned it, where we end up is in the place of, well, people do the next best thing. And the next best thing is when everything goes wrong, just put all your money at JP Morgan.
So I want to dig in a little bit more to the side of money market funds and commercial banks being the creators or printers of money in this modern world. And then tying back to a little bit of these couple, things that we've seen over the last couple of years of, say the SVB banking crisis, what happened there, and FDI in insurance. We've shifted to this world of, a collateralized standard. A lot of the financial system is, anchored to, collateral use of T-bills like that. So how does that entire world work? What does the modern, money market fund world look like? And what are they actually holding? Maybe talking about things like reverse repo and that.
I'll actually start by telling you a little bit about the pre-2008 money market world, because I think that leads us to an interesting place. So pre-2008, in common usage, were two types of money market funds. The government money market funds, which were thought of as pretty boring, and let's put a pin in them and come back to them because they get way more relevant. And then prime money market funds. And what prime funds held was largely bank commercial paper. So when you would go and look under the hood, money market dollars in like a, call it 2006 to 2008 era, were often the short-term funding for people like Lehman, BNP Paribas, like HSBC, Citi, Bank of America. And those things still exist, but the size is now much, much smaller. And people were picking up small incremental yield in front of them and saying, well, that's okay, there's not really any risk here. And then in 2008, when Lehman went bankrupt, there was a prime fund called the Reserve Fund that broke the buck, right? Where basically they were like, as it turns out, these things are not always worth $1. Like we've got a problem here.
Yeah.
And it sparked this realization for regulators and for, essentially all of the financial entities themselves that, wow, okay, these are totally not safe. And by the way, AAA, securitizations may not be safe either. But the money market fund, which was explicitly priced at $1 and broke, was a very big point of contention. There was a huge reform effort around that by the financial regulators on the back of Dodd-Frank. So now in the modern world, we largely have government money market funds. And what those hold in simplistic terms, because there's like the SEC registered versions and some other kinds, but it's pretty consistent, is T-bills of, in aggregate, call it 60-day duration or less typically, and then a thing called overnight reverse repo. So overnight reverse repo, and by the way, there's a lot of jargon in the repo market, but as a general rule in finance, the more jargon there is in a product, the simpler the product actually is. Repo is a very simple thing to do. So here's this transaction. This is all of it. I'm going to lend you money for 1 day, and in return for that, you're going to give me some collateral. Like I stopped talking there. That's all of overnight reverse repo. Okay. And so the kind that's used in government money market funds is they will have huge amounts of dollars, trillions of dollars in the current system, and they need it to be very liquid because people may need this back any day. And so they're going to the entire bank complex, to like private equity, to insurance companies and saying, we'll lend you this money, but to do that, you need to give us safe collateral. Ideally, that is treasuries, maybe longer dated treasuries, not just T-bills, but like we'll lend you this money, but we want a large margin of safety and we want that loan to be cancelable daily. So that is highly liquid, very safe. And if you're doing it on government securities, you don't really have credit risk. Because if banks start failing or securities start defaulting, typically the treasuries are going up in value, not down in value. So in credit terms, that is called right way risk. Right? You could be wrong way. If you're doing overnight reverse repo with a bank against that bank's own commercial paper, please stop. Mm-hmm. Right? And so that is the structure of the modern money market fund. Those things really are quite safe. They survived 2008 just fine. And they, they are not sort of, as you were pointing out earlier, and I think poking at, effectively sort of credit creation vehicles in the sense that we think of like banks doing risky lending to private enterprises. Yes, overnight reverse repo has some degree of potential credit extension there, but when you're taking back government collateral, that's pretty limited.
That system, like you said, it survived through 2008. It seems pretty, battle hardened. There's also been a few hiccups over the last few years. In 2019, there was the repo spike that happened. We've seen the reverse repo explode up to like over $2 trillion and come back down. This has all been happening, and it seems like it's a pretty well-oiled machine at this point. So what are some of the issues you're seeing, and how does that relate to what's being innovated in crypto and stablecoins? Where does this fit in? What are we trying to solve here?
If we think from the crypto perspective and we ask, why did this space even exist? In many ways, Bitcoin was a counter reaction to 2008, right? Like buried, non-transparent counterparty credit risk, blowing up a system that everybody thought was safe and revealing to people what they thought was, for some definition of hard money. Like in this case, let's stop hard money at dollars and not go down like the gold rabbit hole. But that they thought were just dollars good might actually not be, right? And by the way, that problem has not gone away. Look at Silicon Valley Bank and Signature Bank, right, within the recent past. Bitcoin was created as a counter reaction to that. The problem with it is Bitcoin, I would tell you, again, back to crypto, not always understanding the lessons of financial history, instead inherited a bunch of other problems with various forms of money that have existed in the past. Like the core issue with like gold-backed money and hard money. And like Bernanke actually wrote about this pretty extensively. So it's amusing. He was like, at the Fed in 2008, is you can kind of have the reverse problem of what people expect in a crisis, which is I can't create more money. I can't engage in stimulus. Like I'm kind of trapped. And if I'm like holding to a peg, I don't have flexibility on that front. So crypto created Bitcoin, and people quickly started to find out there's both scalability and accessibility problems to Bitcoin, as one might expect with a rate limited, hard money, no credit system if you do financial history. That brought us to something called stablecoins. So the first one was created in 2014. That was Tether, though originally it was called RealCoin, if I recall correctly. And then in 2018, there was kind of an explosion of these things where USDC, USDP, and GUSD all launched in the same year. And so from 2018 onwards, we've had these things that are essentially attempting to be dollars on a blockchain so that you can leverage the benefits of high-speed, decentralized payments with no intermediary, but at the same time doing them in fiat currency, not having to denominate them in Bitcoin or ETH. And I would tell you the crypto space built them for that purpose, but in the cross of, I think, what you were sort of raising earlier, they then went and recreated, in many cases, the original sins of some of these financial products that we had just broken in 2008. And so you've had this thing of both sides sort of, trying to approximate elements of the other system and never completely succeeding. Like I analogized it to somebody as it's like playing a game of telephone to tell somebody how to build a bicycle, but they've never actually seen a bicycle or even a wheel. So like you're trying to describe things and then they're just building kind of sort of what they think is the thing. And so you end up with this like very square thing with like hexagonal wheels. And it's like, does this technically work? I mean, kind of, but could it be orders of magnitude better? Yes.
So we can get into it in a minute in terms of what do you think are the best, solutions. But before we get into that, I want to talk a little bit more about some of the stablecoin designs and attempts, and even just the broad-based crypto design and attempts. Because as you mentioned, we came up with Bitcoin, and I would say to retort to what you said, that they would take the Austrian economic route of saying, well, if we have a crash, we need a cleansing crash and just wipe the floor clean and start from anew, and the phoenix emerges and those type of ideas, and debt creation is not a good thing. We should to keep a gold standard. So there's those, counter arguments, and we can talk about the validity of that. But I also want to just hear about, what are some of those parallels that you have these financial history lessons that you mentioned, and what is that parallel that has been attempted in the crypto world in these specific stablecoin designs?
All right, so let's start from good and relatively boring all the way down to extremely interesting and catastrophic as we look at these designs. So starting with good and boring. If anybody wants to look at what a stablecoin should look like if you want it to be safe, go read the New York Department of Financial Services guidance for stablecoins, because basically here is what they tell you. You need to lock it in a box. You don't have access to customer funds. You're a custodian and a fiduciary. These are the funds of the customers, and they're bankruptcy remote. And then they need to be managed by a very narrow set of guidelines that basically make you look like a government money market fund. And that's it. There's no fun in that. What you were doing there is essentially, if we're going to be really reductionist about it, recreating Fidelity or Vanguard's government money market fund business, right, from an asset management perspective, and then putting it in a trust wrapper so people can use it to pay for things. To be totally honest, none of the individual steps are exciting. The only part of this is exciting is that combining them that way lets you use it on a blockchain for payments without an intermediary, right? But all of these are boring things that work properly. All right, let's take one step beyond that into the weeds. If you look at something like Tether, which exists, and I think most people listening to this will have heard of them, Tether looks more like a potentially credit risky private bank. Tether has said repeatedly, they're not levering these assets. They're not taking them and, essentially trying to level her up repeatedly, but they are owning credit risky assets, and they do disclose that. And they're also owning some things with significant volatility. So if you look at Tether's reserves over time, there have been T-bills, overnight reverse repo, but also commercial paper, gold, Bitcoin, private loans. And so this balance sheet looks much more like, some sort of go anywhere fund, or, maybe prime fund plus. They've even left the boundaries of a prime fund at that point.
Versus a traditional, say, money market fund would hold either, short-term T-bills or reverse repo, right? But they're holding a lot of stuff with some duration risk.
Correct. And it's even beyond the prime funds who are holding short-term commercial paper. When you start taking that much duration risk, or putting gold in there, for instance, these are transparently not things that have been traditionally used for dollar price stability. And so Tether in many ways has acted like a private investment vehicle, or like a very private bank. And it's worked so far, but they've also been in a very favorable interest rate regime for most of their life, right? Which is zero rates, very low volatility. Because if you had taken Tether's holdings and pushed them through the experience of the 60s, 70s, 80s, it might not have been as stable in rates and FX markets. So the good news is over time, they've been trending simpler, but that's another model. There's a third model of these things that from a financial standpoint is really just securitizations, right? So if you look at the original model of something like DAI, or if you look at LUSD, what they're saying is we're going to take in volatile collateral, so say Bitcoin or Ethereum. And the reason we're going to be safe is, we're going to take a lot of this collateral relative to what we give you as the stable coin. So maybe you need to pledge us 2 or 3 times the amount that you're going to get back. Now, financial people immediately understand that as, so the stable coin is essentially the senior tranche of a securitization. And you're saying, I've got all of this stuff beneath it that will absorb all the volatility, and it's fine because that's there as a buffer and I can liquidate it. And the answer to that is, yeah, usually, ? And as 2008 showed us, that stuff is not always safe. It comes down to how good is your liquidation? How good are the terms? How big is the volatility? Because here's the reality. If Bitcoin dropped 80%, not saying it will, but if it dropped 80% in one day, anything that was Bitcoin backed is basically going to break the peg. And so you end up in this position where these are products that we know have not always been completely stable. And that's not an argument against creating them, but it is maybe an argument against saying they are always worth $1. Right, in the form of these stable part of stable coins. And then we could take a step really into the crazy weeds and look at something like UST, which was Terraform Labs' stable coin. And I think the best way to understand that structure is actually, let's leave crypto for a moment, okay? And let's talk about something in the real world. So UST worked because you could take Luna, which was the token for the Terra blockchain, and burn $1 of it to get the stablecoin, or burn the stablecoin to get $1 of it. So let's understand what that's really doing by saying, hey, instead of Terraform Labs, let's say that Tim Cook decides to do this at Apple with Apple stock, right? He says to you, we're going to create Apple Dollar. And here's the way Apple Dollar is going to work. If you give me $1 of Apple stock, we will retire that and give you an Apple Dollar. And if you bring me an Apple Dollar, we will destroy it and issue you $1 of Apple stock. Now, Apple is a real business. It has cash flows. The equity has some non-zero value. So this probably works quite well, honestly, at like local levels for Apple in terms of the transformation. It also probably works so long as they keep Apple dollars, quote unquote, small relative to total market cap, right? Because to use a round number, say Apple is a $2 trillion market cap. If you have 100 billion of Apple dollar out there, that's not great if people try to liquidate it all, but the market can probably absorb that over some time frame in terms of Apple issuing stock. But if you had a 2 trillion market cap against 4 trillion of Apple dollars, you potentially have a very big problem if people start liquidating Apple dollars in size, to the point that actually, if you think about it in the back of your head, in some ways you just have $6 trillion of equity value outstanding at that point. That structure and that disparity reveals what was going on with Terra. This is essentially them using their own equity to create like a dollar product, and then allowing the amount of stablecoins to go turbo against the equity value of the chain. In that situation, because like when it fell apart, just to reference the numbers for people, it was over $17 billion of UST, which was something like half or a little bit more than half of the total value of the chain. And so when it started liquidating, like, do we think we could liquidate half of Apple's equity in a single day without something bad happening to Apple? Probably not.
No.
And again, that's why I draw that parallel. It becomes easy to see when you do it that way, but people were calling that a stablecoin. And so I think this is what I mean by crypto not understanding the right analogies or safety, because there was a way they could have done this safely, but it would have involved being much more conservative with the amounts outstanding.
We have an understanding of the different designs. It sounds like a lot of them have already been attempted in traditional finance, and they've had their pros and cons and issues arise. So, okay, but you're a guy that has dedicated a lot of your life to the crypto world and innovation. So there must be something that you're seeing there that's keeping you there. So what are you seeing? What's the actual innovation, and what is it solving?
The way I describe this to people in the United States, right, or really any Western country, is congratulations, your system largely works. So you are in a position where you are least likely to intrinsically understand the value of these things. Because for all of our problems in the United States, here's the reality. If you just had a bank account at JP Morgan or Chase, right, from 2000 onwards, you've been able to just sleep through everything and it's been fine the whole time, right? Like, you're good. And so these things are sort of missing for you. But let's talk about some important parts of crypto that make stablecoins really innovative. One is, and let's even leave Ethereum for this one for now because of like not wanting to fight about fee levels, the ability to do 24/7 instantaneous payments at almost zero fees. Now, this is something that exists in a lot of the world. And there is an argument, and we'll get to why this argument is not persuasive for other reasons, that, well, we could just do this with a private ledger. But the fact of the matter is the US system is kind of paralyzed and not innovating, and the rest of the world wants dollars. And so getting to 24/7 settlement systems real time has actual pretty deep value, especially for consumers and merchants, because most of the delays currently operate to the benefit of the entrenched intermediaries. Like, that's part of the way they make money in this space. Okay, fine. Systemic issue, but 24/7 real time in general, probably a more efficient system overall. And even for people who are like, yeah, but should we run everything like that? The answer is we don't have to, but you can't make a slow system go faster. You can make a fast system go slower. Two, this is back to the discussion we were having about credit risk, is the concept of what is a government money market fund style, no risky credit, no risky lending thing that now exists in payments world, right? This would be the equivalent of me having a debit card that is backed by a government money market fund and my being able to pay people literally in the shares of the government money market fund. So now, instead of having credit exposure to banks, instead of having to think about their risk, instead of having to think about their lending, I could just be like, look, unless the US government goes bankrupt, I'm good. And the dollar being par with the US government being solvent is sort of like sensible in the mind of the average person. You don't need to be a finance expert to think that makes sense. And so this greatly simplifies the system and allows users to take the amount of risk they want to take to use a system for payments, not just in the US, but everywhere. Third is the concept of access to a blockchain. So blockchains are very open access. Let me give you the criteria in general to get your hands on a US dollar stablecoin. You need to have the internet, and you need to have something of value you can exchange for it. That's it. I didn't say anything about onboarding. I didn't say anything about like, oh, I've got a KYC. I don't have to trust a bank. It's, do I have the internet, and can I exchange something of value for one of these things? Either literally on a blockchain, or maybe I literally go somewhere and like hand somebody cash or like sell them a car and they can pay me in stable coins. Fine. This is really, really, really important outside the United States. There are many places in the world where people did not have good access to dollars and are trapped in local systems that are coercive and abusive, and or just have extreme capital controls where now they can get their hands on dollars. So when I was at Paxos and we looked at the holdings of our stablecoins, we estimated about 95% of people holding BUSD were outside of the United States. And to be totally honest with you, a lot of them seem to just buy it and hold it. I think this was, if you look at like source of funds and do some blockchain analytics, our best guesses was places like Argentina, Venezuela, like a lot of Southeast Asia and Africa, where people have had real deep problems with inflation, flipping out of a local currency and into dollars. The last part is self-custody, right? Because again, back to, do I trust my bank? And outside the US, do I even trust my legal system, right? Because if I'm in Russia and I'm a political dissident and I can only use the Russian banking system, I'm getting kind of the worst of all worlds. I'm exposed to counterparty credit risk at banks and expropriation or theft by authorities in my country if I say something they don't like. If I'm using a US dollar stablecoin in a private wallet, I am exposed to none of those things. I have a relatively narrow solution. And by the way, if I say I don't like Vladimir Putin, I'm not going to have all my money like frozen or taken away from me. And so you could also think of US dollar stablecoins as an extension of US dollar norms, US legal norms, and US fiscal policy globally, and not in a mandatory way. It's an opt-in system, but it allows anybody in the world who wants to opt out of their local system and into dollars to have access to that system. And it's when you line all four of those things up together that you start understanding why these are so powerful. Any of them individually move the needle. All of them together in a package, like the sum is greater than the parts individually.
This episode is sponsored by Mantra. The Mantra chain, built with the Cosmos SDK, is the blockchain of choice for regulated digital assets, offering compliance-ready modules and cross-chain interoperability. With partnerships like a $500 million tokenization project with the MAG Group, in collaboration with Zanbank in the United Arab Emirates, Mantra is at the forefront of the RWA revolution. Scalable with up to 10,000 transactions per second and secured by a sovereign proof-of-stake validator set, Mantra is designed for both permissionless and regulated applications, making it easier for institutions to enter Web3. Discover more about Mantra's capabilities and how you can participate at mantrachain.io. All right, back to the show. I feel like those innovations and issues that are being solved, there's two ways about it. And I think this gets into these dynamics of decentralization and permissionless protocols, because, you know, you look at what a country like El Salvador has been doing with Bitcoin. It feels like it's trying to solve a lot of the things you just mentioned, but with Bitcoin, not stablecoin. And then on the other side of things, you know, some of these stablecoins have a freeze function to them. So there is a spectrum of permissionless and decentralization versus centralization and, you know, more government oversight. Where do you sit on that spectrum in terms of your perspective? And, you know, why is there countries like El Salvador that are going the Bitcoin route, and then others where you're saying there's a more compelling, you know, need for stablecoins?
I would say, first, to answer where I sit on the spectrum, I'm sort of an agnostic in many ways on some of these things, and also in many ways not a maxi about any one thing. I've joked with one of my other friends who's a professor at Columbia that the only kind of maxi I am is an anti-maxi, which is to say, I think there's space in the world for Bitcoin and US dollar stablecoins and completely permissionless chains and maybe somewhat permissioned solutions. But you're really talking about pros and cons and trade-offs. Because like, let's take the Bitcoin example and let's talk about El Salvador, right? So you've got Bitcoin. Here's the good news. The US government can't really do anything to you. Like, there's no way to freeze it. Nobody's in control in like a centralized sense of that. But let me also pose the following experiment to you. If you're in El Salvador and you have a Bitcoin reserve worth hundreds of millions of dollars and you lose the private key or send it to the wrong address, now what? Right? That's a real problem in a permissionless world. There's nobody who can do error recovery. There's nobody who can do transaction reversal. What if somebody like commits fraud? How do you get it back? And so the permissionless side of things has significant benefits, but also significant detriments. And those trade-offs are real, right? It's not that one solution is better than the other. On the other hand, let's say that you were let's take a stablecoin with freeze and seize. So let's say that you were using PYUSD instead, right? PayPal stablecoin, right? I built the back end of that. I can say with certainty it's got freeze and seize capabilities. And so if I sent $1 billion of PYUSD to the wrong address and I could prove it and go to PayPal and ask them to recover it, they could do that. Right. So error reversal exists there. The ability to bring funds back exists there. The ability to respond to judicial orders, right, through PayPal exists there. So like if we see Hamas with, call it $1 billion of Bitcoin in a private wallet, there's really nothing you can do about that. Like you can monitor it. You can try to interdict it maybe on some exchanges, but it's hard. But if we see Hamas with $1 billion of PayPal stablecoin, you can literally go to PayPal and be like, hey, can you take that away? And they can do it. And so part of the question you're asking is how much do you trust US legal norms and rule of law? And some people should trust that more, and some people should trust that less. And then the other part that you're asking about is how important is like error tracking, reversal, and permissioning to the effective functioning of my system, right? Because like to take a former employer of mine so that I'm not throwing rocks at random people, Citi may have sent $800 million in the wrong way involving the Revlon transaction at one point. Boy, it would have been nice if that was a reversible system and avoided a lot of legal fees as opposed to what actually happened, right? And so I would say what you're really talking about there is trade-offs. And that's why I'm not a maximalist. I think both of these solutions have space. I will tell you personally, my belief, I think most people will prefer stablecoins and trusting some degree of centralization in return for the ability to have like error reversal, like the ability to recover lost coins and lost tokens, because the deadweight loss of that over time, if you price it in a system, is very high. And I don't know if people really want to operate in a world where like if 1-ish% of tokens are lost on chain every year and like we're running a tokenized financial system, well, that cost is just going to be passed on.
And then the other thing we haven't talked about is CBDCs versus private and commercial stablecoins. When you hear how the Federal Reserve is starting to think about this idea, it seems like they're a lot more pro commercial private stablecoins versus some all-out CBDCs. So what's going on there, and what are the trade-offs in that regard?
So the first thing I would say is kind of like stablecoins. When people say CBDC, the first question you should ask is, well, what do you mean by that? Right? Because people will say CBDC and then mean 50 different things as you talk about it. So let's talk about the spectrum of potential CBDCs. So on one side would be completely permissionless, like dollar equivalents, but on a blockchain that literally function as bearer notes, no controls over them. Just if you control the encryption, you control the dollar. These would be like the US dollar equivalent of Bitcoin in many ways. I would tell you transparently, almost no central banks are considering doing that. And in a way, I tell many of them when I talk about this with them that you need to be very careful because you're changing the definition of what money is for people if you start moving into more like programmable things. Two, and one you hear a lot, and by the way, one I think might actually have legs as a commercial use case, is really just using it as wholesale money. That being like the Federal Reserve looks at this and is like, well, we have this whole system with banks where they have reserves and we do all these. Could we just replace that with like a private blockchain on the back end where that's just everybody's deposits and we can trade them around 24/7 and track it? Honestly, that works fine. And if you're not facing retail, you're just facing large banks to begin with, I would just say that's a technological back end to the system we currently have. Right? That doesn't fundamentally change anything other than making it more efficient. In many ways, FedNow is literally trying to do this but with different technology. So doing it with a CBDC, I'm kind of agnostic to that. Final one is doing it as retail money. And people have tried this, right? Like China is trying this, Nigeria is trying this, Bermuda is trying this. And what you find is when you give retail people permissioned money, you run into two problems. One, it makes the government a retail bank. And let me tell you, go on the internet and read reviews of most retail banks. They're pretty bad. So you're going to attract a lot of fire for stuff like bad customer service. I lost my funds. Why are you not helping me with my account? Like, one thing I ask is like, does the Federal Reserve really want to become Wells Fargo? Right? Because to some extent, that's what you have to do with a retail CBDC to issue it. Number two, you're going to run into the problem of if you make it programmable, if you think you can take it away from people, if you think you can like program in deflation in certain regimes to force them to spend it, then that's not money in the sense of I have a bill, I will always have a bill until I choose to use it. This is now some sort of contingent deposit thing. And you're going to end up in a world where there's a basis between physical cash and like tokenized cash because you've literally changed the terms of the transaction, right? So you end up with like, if you do this with dollars, like a dollar basis to the physical bills versus electronified. So I would tell people, be very careful about changing the features of money. You could very easily make it very undesirable and actually do some funky things to like the value of your currency if you're not careful with the programmability. I also think like in the US specifically, we have a lot of constitutional issues with that. Like it may be the case that like to close somebody's account, you need to go get a warrant, depending on how you do these things. So I remain pretty bearish on adoption of retail CBDCs other than in extremely autocratic countries where they're willing to force people to use them at the point of a gun because consumers just don't want them. On the other hand, I'm actually quite optimistic about like wholesale CBDCs and back-end replacements because rather than using what is quite frankly 1980s technology, upgrading that so that all the banks and central banks can just communicate more efficiently is probably a huge positive.
Yeah, okay, so that makes a lot of sense. One thing that I hear a lot about is when people talk about blockchain innovation, even if it's not fully decentralized, they say, okay, well, what's innovation there versus just using a database? But I think, what you're getting at with some of these ideas of like wholesale blockchains between banks and that sort of thing, it sounds like there's an innovation there that's better than just a database, even if it isn't fully decentralized. So is there innovations on that regard?
Yeah, and I think it comes back to sort of the crypto community talking past the finance community and the finance community talking past the crypto community because decentralization is not a monolith. It is not that we have a choice between like Onyx at JP Morgan, where JP Morgan has unilateral control of the system, and Bitcoin, which is totally decentralized and nobody, right, has control of the system. Because like, let's take this as an analogy and ask at what point are we decentralized, right? So on one end, let's say I have a chain run by a single bank. Everybody would agree that's not decentralized. But what if I have a chain run by a consortium of, call it the 25 largest banks, and they are all mutually agreeing to terms to clear things between them? It's certainly more decentralized than the one I just said. By the way, that's similar to how something like DTCC operates in the real world, right? Mm-hmm. These things exist. Now let's take it a step further. What if we bring more people into that? What if, and we'll do this in America for now, we have all of our major banks and asset managers and insurance companies working together to validate a chain that everybody is using both for payments and to exchange securities. Well, now that's getting pretty decentralized compared to the first option. And no, it's not anonymous global validators, but now you're talking about hundreds of companies with nobody having unilateral control to change the rules on people or change transactions. Take that a step further. What if it's that same construct, but for every major nation in the world? So now we brought in Europe, we brought in China, we brought in Japan, we brought in India, and we have this global chain of financial entities exchanging value. That's starting to get extremely decentralized at that point. Certainly, it's going to be very hard to unbalance something there. And then finally, you can get to like anonymous public validators that everybody runs. And the thing to understand in this pyramid is at each level, what you're doing is essentially trading away control, but also trading away coordination, right? If I had a major structural problem on a fully decentralized public anonymous validator blockchain, it's probably a lot harder to fix that quickly than it would be certainly with the private bank chain or even with some of the consortium models. And so to me, this is not monolithic, and it's entirely possible that the preferences, especially for like, call it mainstream financial transactions, will be at neither of the endpoints of that stack, but actually probably, if we're being honest, somewhere in the middle. And that's something that I think the bank community has not really thought deeply about governance. If you look at many of the efforts by like the BIS or like individual banks, they've just kind of waved their hands at the governance problem and assumed it away in a lot of cases because they want to control it themselves. And in the crypto community, there's this very libertarian theme of like, well, it should be as decentralized as humanly possible, and that's good. But exactly as we were talking about with Bitcoin, that comes with real trade-offs as well. And my guess is neither of the maximalist ends will win.
What's up, everybody? Just want to take a second out of the show to talk about the next major Blockworks conference that's happening. Permissionless 3 is a leading crypto conference, and it's going to be happening in Salt Lake City this year from October 9th to 11th. There's going to be some major legendary speakers there from the likes of Balaji, Chris Dixon, and macro veterans like Dan Taffiaro will also be there. Not only that, but we're also going to be doing a live recording of the weekly roundup on the Margin Guys Emporium edition. So you can come meet myself and Tyler and Quinn, and even Mike will be there. If you're interested, we have a discount code, Margin10. Use that and you'll get 10% off as well. So I hope to see you there and that we can catch up. All right, back to the show. Yeah, I would agree with that one as well. I want to wrap up the conversation by talking a little bit more about the macro sovereign issues and opportunities that come with everything that we've talked about. So maybe we can frame this conversation through just the dollar reserve currency hegemony that we currently live in. You know, there's been a lot of talk about how, okay, stable coins like you know, Tether is one of the largest marginal buyers of U.S. debt these days. And, you know, in a world where foreign sovereigns like China and Japan are actually they're definitely not buying, they're potentially also selling U.S. debt. So they're not the marginal buyers these days. The Fed isn't buying debt these days. They're, you know, in QT mode. They're on the other side of that. There's a lot of talk about how, okay, we have these private enterprises that are coming in and being huge buyers of U.S. debt. Where does that lie in terms of these philosophies around the U.S. dollar reserve system and whether this actually helps improve it? And does that lead into why, you know, Congress is talking about stablecoin law regulation and those ideas? Is that framed around this idea of continuing that dollar hegemony, or how do you view it?
Yeah, I think there's two parts of this that are relevant geopolitically. And, you know, back to Congress, and some people have been thinking about this for a while. Let me say there are two people whose stuff you should read on this, which is Nick Carter and then Paul Ryan, who is literally the former Speaker of the House of the United States.
Yeah, he gets it.
They have been talking about these exact issues. That is correct. And so I would say element number one, just supply and demand. When less people want to buy your bonds, the interest rate goes up. When more people want to buy your bonds, the interest rate goes down. And so if we live in a regime where, call it central banks in other countries are trying to get rid of their dollars and buy less dollar debt, if you substitute that in for retail demand, you can at least get back to neutral or maybe even get positive on the demand curve for dollars compared to where you would be if US dollar stablecoins did not exist. Because going back to what we talked about earlier, again, to buy one of these, you just need the internet and something to trade for it. So you could tap a huge pool of buyers that potentially you didn't have before. And in the current US fiscal situation where we have a large deficit and, to be blunt, need to find a way to start reducing it over time, this sort of act dramatically extends the runway for us to do that. So the entire process becomes less painful if we take advantage of that opportunity. I think if you were talking to Paul, he would explain that to you, and that would be his key point. The second point, which is something, you know, I've talked about before, is there's a deep national security implication to how we do this as well, right? Like we are essentially with US dollar stable coins that are domiciled in the US or with our allies and have freeze and seize capabilities, exporting dollar norms. Because let's take some examples of these countries. If somebody is a political dissident in Russia trying to get capital away from Putin's regime, we can let them keep the stable coins. But if it's literally Putin, we can take them away. And so what it does is it allows us to extend the reach of dollar sanctions and also apply them in much more targeted ways. Because when you do things like exclude the entirety of a nation from SWIFT, you're kind of throwing the baby out with the bathwater if there are US allies or dissidents in that nation and cutting them out as well. And so this allows you to be much more targeted, much more specific, and expand dollar access in ways we can't while maintaining some degree of control. It's also an information battle. If I have the KYC information here, so like everybody onboarding through Coinbase and minting USDC, in theory, that information is available to the US government with a warrant. I'm not so sure that would be true if the stablecoin was running out of Russia or mainland China. And so there's a geopolitical element to, we want these in our territory or friendly territories in our currency. And then we have significantly more control over the system. And if you believe, like I do, that US rule of law, while not perfect, is still better than many of the other options, that's a net positive for the world.
That sounds like a win-win scenario for US dollar hegemony. So it surprises me that it's become a political issue. Why is there contention around this? Why is there a political divide? Why is there some people in Congress that are super, anti-crypto, anti-stablecoin, all of these ideas? What's going on there?
I think a lot of it, to be totally honest, is driven by misunderstandings. So Richie Torres at one point was on Laura Shin's podcast, Unchained, and talked about one of the problems with crypto being the gerontocracy, by which he means one of the best predictors of if somebody is pro or anti-crypto in Congress is how old they are. Like, the correlation is not perfect, but it is significant in terms of who gets this and who doesn't. Because if you're, to be generous, 80 years old and still struggle with email and still kind of think maybe PayPal is a scam, crypto is probably now so many steps removed that it's just like, no way, no. Like, they're not even engaging with the idea. So there is certainly an element of what I would call technophobia from some of the senior US legislators from Biden's administration and from some of the folks specifically at the FDIC and to a lesser extent the Fed, the SEC, the OCC that is driving this. Number two, let's be totally honest, there's a lot of special pleading by banks. So if you're a banking regulator, you constantly have banks in your ear telling you these things are dangerous, they're going to destroy deposits, they're going to destabilize the system. But what that actually means is it's going to destabilize bank profits and executive compensation. Like, there is no reason that we need to give a payments monopoly to the banking system and essentially subsidize lending to real estate billionaires via people who just want to use the system for payments. That doesn't need to happen. There's no structural benefit. It's just an economic benefit. But this, this is why you see like a lot of the bank lobbies fighting stablecoins so hard. Of course they don't want it. They have every economic interest to try to oppose this. The last part is, I don't think people really understand how much more transparent blockchains are, and you end up with the streetlight problem, right? That is to say, for instance, Elizabeth Warren at one point was on the anti-crypto campaign again about, look at Hamas receiving all of this money through crypto. But the irony of that is we only know they received it in crypto because we can see the system and track it. Over 99% of their funds come through the traditional system, but you're not up there banging the drum about that because it's so fragmented and opaque, we don't even know where it is, right? So this is a real misunderstanding. I would tell you, this is maybe my hottest take on blockchains, that if we today snapped our fingers and forced every single bank to use a blockchain that was publicly observable, we could probably cut the rate of financial crime by 80% or more.
That is a spicy take. I love that. And it makes sense to me. Okay, so just want to wrap up by hearing about your thoughts over the next 12 months or so. Is it entirely dependent on the election outcome? There's this major stablecoin bill that's trying to work its way through Congress. So what's the landscape for the next 12 months? How are you seeing it?
In a weird way for stablecoins, I think it's less dependent on the presidential election and more dependent on Congress. Mm-hmm. So I would tell you there is currently the will and the votes to pass stablecoin legislation out of the House, right? So if it were the Republican House alone, they would pass it right now. It would be law. I think the biggest blocker is actually the Democrats in Senate banking because of Elizabeth Warren, and Sherrod Brown has been aligned with her on this. And they're the ones largely sitting on this. And I think they don't want to move at all. And if senior leadership from the Democratic side moves, they want to trade something for this. So to me, the easiest unlock for stablecoins in particular, talking on that angle, would be if the Republicans take the Senate in the presidential elections this year, or it just looks like they're going to, because then the Democrats might move to get a better deal now than if they wait until after the election. So to that extent, and that goes back to what we just talked about with age, technological understanding, special pleading, cleaning some of that out is probably the thing that unlocks stablecoins. And I want to be clear, there's bipartisan consensus on stablecoins. Like, I testified at House Financial Services, and two of the people most in favor were Richie Torres and Wiley Nickel, both Democrats. And so this is not like a partisan point on US dollar stablecoins. I think it really is more of a misunderstanding and like elderly versus less elderly technological understanding. Fine. For everything else, market structure, the SEC, things like that, then I think you're getting significantly more into the presidential election, right? Because if Donald Trump becomes president, let me assure you, Gary Gensler will not be the chair of the SEC for very long. On the other hand, Harris has been quite ambiguous on this. And while, in my personal opinion, I think it's likely a Harris administration is better for crypto than Biden, that is not a statement that they are necessarily good. They've been very quiet on it. There are some of the very anti-crypto people still involved. It's just as you level up technological understanding in general, I think at least on some of the edge cases and worse things, you'll sand some of that off. But there, the presidential dynamic matters much more. So I would say it this way. I'm significantly more optimistic on stablecoins because the worst case scenario for both parties is that you push all of this offshore in ways you can't control, or even worse, you push it into another currency. And I think they know that.
Well, look, Austin, that was a really illuminating conversation. I hope that we are improving in the realm of helping TradFi and crypto worlds talk to each other, because I think that's one of the most important things, to actually, be innovating and not just reinventing the wheel in weird ways, and making the same mistakes of financial history. So really appreciate you coming on and giving your insight on all of that.
No, thank you very much. And if I can leave with one last note, it would be for everybody in crypto world, please listen and take it seriously when the people who know TradFi risk talk. And for the TradFi people, please be open-minded about some of the innovations of crypto, because as I joke with my friends, I'm in this space despite all the people who have been building things because I believe in it.
Well said. I love it. All right. Thanks, Austin.
Thank you.